What's up, everybody? My name is Joe Brown, and this is Heresy Financial. In a move that was a little bit surprising to me, Biden nominated Jerome Powell for the position of the Federal Reserve Chairman for a second term. And so today in this video, we are going to talk about what that means for the markets and the economy going forward into the future. Ready? Let's dive in. Well, just like me, it seems the market was anticipating a little bit of a higher chance of Biden not nominating Powell for a second term. And so on the news of the nomination, markets started to sell off. That's stocks, that's bonds pushing interest rates higher, especially short-term interest rates, along with the dollar higher, which also sent gold, silver, Bitcoin lower. Which means that at least for the moment, the market is now pricing in a much higher likelihood of the continuation of a taper. We know that the Federal Reserve announced that starting this month, they are going to be reducing their asset purchases by $15 billion every single month, which means that by the time August of next year rolls around, they're not buying anything. Now, obviously, this is just a nomination, which means that the next step is confirmation by the Senate. However, he has broad bipartisan support, with only a few like Elizabeth Warren expressing dissatisfaction with the job that he's done, which means that it's almost a certainty now that he's going to be doing another term. So what does this mean for markets? Well, like we're seeing today, it looks like the market is pricing in much higher chances of the taper, the asset purchase taper, continuing. And that's important for any of you who don't know. What they're doing right now is an asset purchase taper. So they're started with $120 billion per month of asset purchases. They're winding that down to the point where they get to zero. Looks like after that, they'll start to worry about raising interest rates. We all remember back in 2018 when the Federal Reserve was tapering, they were both raising interest rates and selling assets off of their balance sheet. The market couldn't handle it in 2018 anymore. Towards the end, they had to reverse course to help stop the market crash. They kept on tapering their balance sheet, however, at that point, and continued that until, again, the market couldn't handle it. And the repo market blew up in September of 2019. And then again, they had to reverse course and start not QE in September of 2019. And keep in mind, the mechanics of this, the reason for this is because quantitative easing, QE, that's adding cash or money into the economy through different mechanisms like the banking system. It expands the money supply. And just as QE expands the money supply, when the Federal Reserve is growing its balance sheet, it's adding to the money supply. When it's lowering its balance sheet, when it's doing quantitative tightening, when it's selling assets, it's withdrawing money from the money supply. It is contracting the money supply. Because if the Federal Reserve is absorbing cash by selling assets, somebody has to buy those assets from them for that sale to take place. That means cash is leaving the economy. And monetary contraction is ultimately deflationary. And when you have a system built on inflation and you start to do something that's deflationary, that's when you get a blow up. And that's what's happening right now, at least anticipation of that, because you have a big buyer, the Federal Reserve, who's signaling, hey, we're not going to be buying anymore. We're going to be stepping out of this market. That makes everybody else in the market think to themselves, hey, well, if we can't rely on the infinite money printer to step in and keep asset prices high, what should these assets be priced at? And if they're too high, I'm going to sell. Also keep in mind right here, stocks are reacting to bonds. As the Fed buys bonds, they keep interest rates low. Interest rates and bond prices are inversely correlated. And as interest rates are low, it allows the most over-leveraged global economy in history to continue to roll its debt over. But the economy right now is like a debt junkie with maxed out credit cards on a 0% intro APR that can barely afford their payments, and they're about to be hit with those interest rates resetting to normal, going up as that intro rate runs out. If they could barely afford their payments at zero interest before, what do you think is going to happen when interest rates start to go up? Suddenly, somebody's insolvent, and that's going to mean that their stock price will react violently downward fairly quickly. And so with Powell at the helm for another term, it seems that they are set on course for continuing the taper, at least for now. And the reason for this is because in the public's eye, it's necessary given the persistent and record-breaking inflation that we've been seeing. And like I said earlier, the inflation is a result of the unprecedented level of monetary expansion that we've seen over the last 2 years. And so they have to do something to make it at least look like they're trying to address the problem of inflation. The only problem here is that if they do accidentally contract the money supply too much too quickly, that could very quickly spill over into a complete economic crash. And given the timeline that the Federal Reserve has this taper scheduled on, I would not be surprised at all to see some trigger like this happen towards the end of next year. Now, I've detailed this before, but once that crash starts, they will stop it in its tracks, or at least they will try. Because now they have precedents for opening up emergency channels to deal with an economic crisis very quickly. They can buy more treasuries. They can drop rates again if they've already been able to raise them. They can buy up enough bonds anywhere on the yield curve to effectively peg those interest rates to zero. That's yield curve control. They could peg mortgage rates to 1% or even lower towards zero. They can buy junk bonds. They could theoretically even buy equities through an ETF held at the Treasury like they did to buy junk bonds. Now, they may need congressional approval for that, but I would not be surprised at all to see something like that happen. And so when, not if, but when we see a panic, or a crash start, or an emerging markets crisis start to spin out of control, or any reveal of the rot that's exposed by the taper but was caused by the easing, they will reverse course immediately, just like they did in 2018 to stop the crash, just like they did in 2019 to bail out the repo market, just like they did in 2020 to bail out everyone. They will do it again in 2022. And finally, if you'd like to learn advanced option strategies to take advantage of these crazy market times, check out my options courses linked in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.